Welcome. My name is Brandon Wendell, and I'm an instructor with Online Trading Academy. And I am going to do a little video, an introduction to spread trading in the futures market. This is a subject that's often overlooked, and it really should be focused on a lot more. It's something that it allows you to trade in the futures market with three things: high probability, low risk, and high profit potential. And that's something that we always want to seek out when it comes to our trading. So we'll take a look at the differences between what we call directional outright trading, which is normally what people do. You buy when prices are low for the intention of selling at a higher price, or sell futures contracts when they're high for the intention of buying them back when they're cheaper. Well, we're going to be doing a very similar thing to this when it comes to spreads, as you'll see, but not quite the same. Now, I'm going to use one of the tools that we have called ProPicks. This is something that Online Trading Academy offers its students as an educational tool, and you can see it gives you a lot of details about how a professional would approach a particular position. So here you can see that the detailed information on the trade, how to enter the trade, how to manage the stop. We also have a running time log that kind of timestamps and lets you know what's going on as the trader is navigating through the markets. Now, in this particular position, they were entering about 910 and a half with a first target of 919, and the second target unfortunately was not achieved. What happened was prices pulled back a little bit after hitting the first target. Fortunately, though, a profit was retained because the traders put in a trailing stop. So overall, there were 3 contracts traded, as you can see, the trade results, and we had a profit of $1,250 for that position. Well, when we take a look at this with the outright position, buying the 3 contracts, for every contract you wish to buy, you must put down a deposit known as margin. And in this case, the margin deposit for soybeans is $2,180 per contract. So you guessed it, if you wanted to do 3 contracts, you're spending a little over $6,000 as a deposit to invest in this particular position. Now, going over to the spread. In a spread, what you are going to be doing is buying a contract and at the exact same time selling a related contract. Can't be the exact same, but it has to be related. So what we're doing now is called an intra-market spread. This intra-market spread involves you buying soybeans, perhaps the November contract, and then selling soybeans, perhaps the December contract. By buying one contract and selling another, you would think you're going to be net neutral, but the contracts don't move at the same pace, so you can profit from the price difference between the two related securities. The nice thing about this is you can see there's a maintenance margin of $405. However, the initial margin to get into this trade is only $445.50, and that's for both contracts. So again, we would buy one contract and then short a different contract, but related. And by seeing the prices move together, again, one contract will move faster than the other and offering you a bit of profit. So comparing the two, if you just simply did the outright position like the traders did, they put down a deposit of $6,567. However, they had risked $675 to take that position. The profit that was taken was $1,250, so as a rate of return of 19%, which is pretty good. However, in the spread position, once again, you would have been buying a contract and selling a contract at the same time. So in this case, we were buying 3 contracts and selling 3 contracts. And on the spread, with the reduced margin, the trader only had to come up with a $1,336.50 investment. The risk was also reduced to $187. Of course, the profit from the trade will also be reduced. They made $300, but notice the rate of return. We got a better rate of return by trading the spread over trading the outright position. So by doing this, you had less capital required, better rates of return, and higher probability for success. So we'll take another example, or actually before we look at another example, I want to mention something else about the spreads. What happens with spreads is that you can also do something called seasonal spreads. And when it comes to seasonality, what happens is a particular company will go out and examine the markets over 10 to 15, maybe even as high as 30 years of time, and they will see when is the best time to invest in these spreads. And historically, what will happen is that certain spreads will repeat themselves over and over and over again in a particular manner. So if you look at this particular trade, this was buying the August soybeans on June 23rd and at the same time selling the March 2020 soybeans. So obviously every year would be different years, but it's simply buying the August, selling the March, June 23rd, getting out on July 3rd. Over 15 years, there was only 1 year where there was a loss. So that was a 93% win ratio if you followed that particular trade. So I want to thank MRCI.com, the source that I got this particular seasonal information from. Now, if we take a look at another directional trade, here we have the Nasdaq futures on a daily chart. And if you wanted to trade the Nasdaq futures here, you can see it was down in a daily demand zone back in May and rallied up quite nicely towards an area of supply. Well, by getting into that position, if you had bought at the demand, sold at the supply zone, you would have profited 774 points. At $20 a point, you're looking at over $15,000 profit. The downside is you have a bit of risk, obviously, and you also had to come up with $8,000 for your margin deposit. So, an alternative now that's very, very recent, they introduced something called micro contracts. So if you wanted to trade the exact same thing, you could have done it with a micro futures contract, buying at the demand zone, selling at the supply zone. It's a different symbol, and it's also a different margin requirement. Instead of $8,300, it's only 1/10 of that, so it's $836 roughly. Of course, if you're reducing your risk, you're also going to be reducing your profit. So we've dropped down to $1,524 rather than $15,000 profit. But again, you come in with a lot less capital, and it makes it a little more affordable for traders to be able to trade overnight when they don't have large accounts. Now, if we look at a spread, we can trade the full-size contract once again. Notice I went back to the NQ. This is the September contract versus the NQZ or Z, and that is the December contract. What you would do in a spread is buy the September contract. You see it went up, and at the exact same time, you would sell the December contract. Now, why might you do this? Well, as you can see, the price down here, this is called the spread difference. It's simply a chart of the top security minus the bottom security. And in this case, the spread widened. Or actually, I take that back. I guess it kind of narrowed from the negative that it was. But what happened, nonetheless, if you had bought the upper contract and shorted the lower contract, if both of these contracts dropped at the exact same pace, you wouldn't have lost or made any money. And if they moved up at the same pace, you would not have lost or made any money because one would lose, the other would win the exact same amount. But what happens is, you can see the front month, or September, moved a little bit faster than the back month, offering you a 23.75 point profit. So why do we do this? Well, if we take a look at the three different types of positions here on the Nasdaq, that outright position, your margin requirement was $8,300. You made 183% rate of return, or a profit of $15,295. On the micros, if you're a little bit, maybe you're newer to trading, or you just don't have as much money in your account, you want to be a little safer, you could trade the micro for $836 margin. You reduce your risk and your reward, same rate of return, but it's $1,500 profit. However, you're not going to believe this. When we go to the spread, we really reduce the margin requirement because the chances of loss go down dramatically. On the future spread position now, the margin for one spread, which would have been two contracts, remember you're buying one contract and selling another contract at the exact same time, it's only $44. Yeah, I didn't misstate that. It was actually $44 for that spread. The profit from that trade on that $44 investment was $475, or a rate of return of almost 1,100%. So you can see the spreads are a great opportunity to be able to hold these very expensive contracts overnight for a great rate of return at very low cost. As a matter of fact, there's also seasonal spread trading when it comes to the markets. I mentioned earlier the intra-market spread that we saw on soybeans, and we can do the same thing with a lot of other contracts. You'll see right here, March wheat, July wheat, December cotton, and July cotton, February live cattle, and October live cattle. These are what we call intra-market spreads. And the thing to take a look at here is the win percentage. 93%, 93%, 100% of the time over the last 15 years, they made profits in those spreads. So the margin costs are reduced dramatically, and not only that, but the probability of win is extremely high. Now, we can also do what are called intermarket spreads. You notice the fourth one down is gasoline, July, and July crude oil. So the month is the exact same, but what's going to be different is the security you're trading. We have August feeder cattle, August live cattle, December corn, December wheat. Even those have very high probabilities of working out. The lowest probability we see is 87%. So learning how to trade spreads can be a very profitable opportunity for many, many traders who thought they could never trade overnight because of the cost of carrying those positions. So I mentioned I'm going to be teaching these in what's called the Signature Series. It's a 3-day program that's followed up with a 1-hour online course or online follow-up where you get to see these strategies taken in the live market environment, as well as answer any questions you might have as you're employing these strategies in the market. And the Signature Series, over those 3 days, only one piece of that is going to be the future spread trading. It's a big piece, obviously, but we're also going to be looking at a few other topics as well. Such as the RSI as an odds enhancer to help people out with trend, intermarket correlations, and my 889 trading strategy that I've been using for many, many years with a lot of success in the markets. For a little more detail as to the um, what you'll actually learn in the class. The first part, the RSI is an odds enhancer. If you are struggling with finding the correct trend that your security might be trading in, RSI is a tool that can help you out with that. It can make it easier to determine what trend you're trading in and therefore be on the right side of the market. It can also be used, if you use it correctly, to filter out low probability trades and make sure you're not taking unnecessary risk. Intermarket correlations is something that's very, very overlooked. Intermarket correlations allows you to get higher probabilities of success in your trades because you can look for related securities offering confirmation or an odds enhancement when it comes to your trades. You can also look to see what securities might be substituted in order to get a better rate of return using less capital. And probably one of the most important pieces and things you can do with the intermarket correlations is timing trend reversals. When you look at correlated securities, when those correlations start breaking down, that's usually a signal that a trend change is imminent. So the next thing we can look at is the 889 trading strategy. And really, this is just an odds enhancer for the Online Trading Academy core strategy. It can be used on any asset class and it can be used for any time frame. So I go over that in detail. And of course, learning how to trade spreads using very low risk opportunities to find high probability opportunities. Anyway, who should attend the class? It should be anybody. First of all, you need to have gone through the futures class at Online Trading Academy to know how to trade futures properly. But it's for students who are looking for additional help in determining the trend for the best trade direction, those who are looking for high probability opportunities in the markets, people who want to trade futures overnight but have limited funds, so you can't quite meet the overnight margin sometimes, you can now trade them overnight. And if you want to get more bang for your buck in your retirement accounts, get away from those mutual funds, get away from those ETFs, and trade a leveraged asset in your IRA. It is possible to open up a futures IRA account. So in a nutshell, that's kind of what we're talking about in the 3-day Signature Series course featuring myself, Brandon Wendell. I hope to see you in one of those courses coming soon to an Online Trading Academy center near you. Thank you for your time.